Let's go.
Good morning.
There he is. Very good. Thank you very much for doing this. I think it's quite interesting to hear how it's been going with Edinburgh Investment Trust. Obviously, things have turned around in the UK market, and I think there'll be quite a lot of questions about what you've been up to. But I think, as usual, we'll just start off with you talking us through what the fund's trying to do and how it's going about it, please.
Yeah, thanks, James. So I'm going to move at pace on this one because I've been briefed on 10 minutes. So we've got a few slides to rattle through. Really what I'm looking to do is put together a 40 to 50 stock portfolio with the team I work on. The joy of this is we can not only pick stocks from the UK equity market, but also non-UK stocks, and we can talk about that in questions. The style which we adopt is what we call a total return approach, which is basically thinking about both capital and income, because I think, if you skew it too much to income, you might actually get companies for whom the income, if you like, is more of a tide. What we want is companies for whom the income naturally flows off the cash flow statement. We do this by, in the main, really nitty-gritty sort of fundamental competitive analysis. And, ESG has obviously come up on the agenda dramatically in the last 2-3 years, but frankly, it's always been part of our process. We think about it as sort of responsible capitalism. Companies need to craft their profits with respect to society. We're lucky enough, obviously, to be doing this within the Lion Trust umbrella, which provides really good risk oversight. And obviously, our aim is to outperform. And without further ado, next slide, please, James. So this is the performance, crucial in any trust. You can see there we started in the teeth of COVID when we were decamping, not knowing really what COVID was at that time. Our then Prime Minister was in hospital. This was really odd times. But you can see there over the totality, which is some 2.5 years. If you look at the right-hand side there, we've produced some good performance. What you can see there is the net asset value is some 10% plus ahead of the all-share index over that period. It's obviously a positive number. And then the share price, as the discount has moved in from a very uncomfortable double-digit level to a single-digit level where it is at the moment, it's approximately 7%. So still work to do. You can see there the share price is up some 54%. And I borrowed a little phrase from our chairman, who our outgoing chairman, Mr. Suarez, who termed it a very encouraging start. But I'll leave you to judge on that. So yeah, good start in what is, the critical aspect of any trust, which is the performance. Next slide. So next slide is really just showing the team. All I really want you to do is take away from that is that we've got substantial bandwidth, frankly. So next slide. Yeah, so next slide is the investment approach, and I'll just spend a moment on this. So, we start with the macro. We spend about a quarter of our time thinking about the macro, and I've got a slide in a second on that. But in essence, what we're trying to do is think about the building headwinds, obviously trying to avoid that, and think about the tailwinds which might be building. And really what we're trying to think about is kind of the flavor of what might be in the FT, the Wall Street Journal, on a 6 to 9 month view, because that's really what is going to determine what will be driving performance as we go forward. But the vast bulk of the time which team you saw on the previous slide spends their time on is really getting into the guts of the companies themselves. And what I really say to you is that we spend the vast bulk of our time before we plunge into the sort of footnotes of report and accounts and build Excel spreadsheets to think about the earnings power. A big part of our time is really thinking about the competitive strengths that a company might have, because after all, what we're really after is companies for whom, you know, if you're competing against them, they're really difficult to compete against. You know, we want companies for whom, if you're competing against them, they almost sort of think, these aspects are just not fair. They're very, very difficult to replicate. So, you know, if you think about a company such as RS Components, which is, you know, reported relatively recently, you know, the gap, and you can see if you click on their investor website, the gap in their sales growth relative to competition has widened over COVID. And that's a combination of things: competitive fatigue in their competitive set. It's also, the reality is, if you think about what they do, you know, they are distributing on a just-in-time basis a huge array of product. You know, the SKUs they have in their warehouses can be up to 700,000. They also stock up to 2 million on an extended basis. They're obviously liaising with 2,500 suppliers over 80 countries. I mean, these are staggering statistics, and obviously data is a big thing. And so, you know, the gap between them and the competition is endlessly widening and very, very difficult to compete against. So, you know, the returns that business throws off are such that, you know, it really warrants a very strong position in the portfolio. And if you think about the macro trends there, it is essentially reshoring. If you think about what every company is looking to do at the moment, it is brainstorm their supply chain to think about the single points of failure. And electrodes is a big beneficiary of that. So next slide, please. Yeah, so this is just a word on the macro, and I was amused to read in the papers. Well, not amused, but it was a very good summary, I think, to see that the Collins Dictionary had chosen the word permacrisis as their word of the year, and I think that sort of sums up the fact that, you know, actually investors are in pretty bad psychological shape, actually, as we sit here. Or if you look, and if you want to Google some of the Economist titles which we've had, and I use it as in the Economist magazine titles, if you think about some of them, and I'll just quote them. You know, there was one about a month ago, How Not to Run a Country, with a picture of the then Prime Minister in a canoe. There was Welcome to Brittany. But more recently, there's Reasons to be Cheerful, with a picture of our new Prime Minister, Mr. Sunak. Now, obviously, in terms of the actual reality, the pound is at a low ebb. I borrowed a headline from the FT. You know, the dollar is strong against all currencies, but particularly against the pound. And I think that shows a pressure valve of what international investors think about the UK. Some purchasing power parity is a lot higher. Then if you think about other elements of the setup, because pound being at a low ebb, I think arguably is good news. Then if you think about the flow data, you know, many of the listeners will be aware that actually retail flows in the UK have been one way really since the Brexit vote. But also, if you look at a long-term perspective, pension schemes have been either moving towards global equities for the last 15 to 20 years or moving into alternatives. And I've shown there some data from Calistone. So, you know, the setup, as in the supply, is very good in that it's very, very skinny in terms of positioning for the UK. Then if you think about what we're entering, and obviously today we saw some stats out on the UK economy which showed that growth was negative in the most recent quarter. And I think people immediately in their muscle memory think about the last recession. The last recession was obviously a bad one, some 6%, you can see there, peak to trough. It's my and our team opinion that this recession will arguably be less bad. Why I say that is the imbalances will be less. You can see that unemployment is at a relatively low ebb. It's just very, very different to 2008. The banks are in good shape. There are a number of data points that all point to actually a much more muted a recession, as indeed Lord Wolfson, who's a very shrewd commentator, talked about yesterday. So, I'd say the setup for the UK equity market is relatively positive. Next slide, please. I'm gonna jump quite quickly over this one, but leave it perhaps for questions, just because I'm conscious of time. But what we've set here is some logos of purchases we've made, and the key point I'd like to make is that we've been selling some of the more defensive, reliable growers and buying into some of the more edgier situations, which I think are more appropriate for the market on a 9-month view. But obviously happy to answer any questions on those if listeners wish. Next slide, please. Again, time is relatively short, but the key point I'd really love listeners to take from this is that the way we and the team set up this portfolio for the trust is to have multiple themes in terms of how we're layering the portfolio. One of the massive themes, I would say, though, is Darwinism, this idea that against multiple black swans, which we've seen over the last 3-4 years, which has developed for many companies a degree of sort of corporate fatigue. Actually, what we're looking to really champion is the companies for whom, they are really crunching the competition. So if you think about what Premier Inn within Whitbread is doing relative to the competition, it really is widening the gap against not only the independent chain, but also the franchise operators who are much more geared than Whitbread. And Whitbread is obviously vertically integrated. It's not paying fees to things like booking.com, et cetera, and therefore, again, if you look at its investor website, it's no surprise that actually the gap between them and the competition is dramatically changing. But again, with the need to sort of keep roughly to time, I'm going to leave that for questions if there's any questions that sort of come along from that. So next slide, please, James. This again is a slightly dry slide, but what it's looking to do is just give you some, actual data of the sort of key positions relative. So on the right-hand side, it gives you a feel of when we're really punchy about a holding. We look to have 3% plus active bet on a particular holding. So the NatWest, the Tesco's, the BAE Systems, or the RS, which I've talked about. These are the types of holdings which we'd be holding. What I'd also emphasize is that we do have non-UK listed stocks on the international thing, bottom left, you can see there some 11%. And what I'd also emphasize is that we've actually been building up the sort of mid-cap as there've been big opportunities, I think, in the last 3 to 4 months. So buying the likes of Howden, Travis Perkins, to name but a couple, or the likes of M&S, where we see, really quite interesting valuation opportunities. Next slide, please. And this is my final slide. I mean, really, Edinburgh Investment Trust, I think, is a really interesting way to play what I believe we're going to see in the UK equity market. We're going to see something of a UK equity renaissance, because the valuations are very low, and I think many of the elements for which the UK equity market has been marked down, if you like, the perceived Achilles heel, are actually going to come into their own. So if you think about, the banks, they're now in a very strong position. They're now making money from both sides of the balance sheet. Liquidity's good, risk management is good. It appears that the recession which we may go into would be relatively shallow and dealable, and therefore the dividend flow from these is going to be very strong. If you think about the international energy companies, it's now very clear, it's very important where we get our energy from. So the likes of Shell, the #1 player in LNG, is a very, very valuable business. If you think about transitioning, we need copper. So the likes of Anglo American, which is massively growing its copper assets, is again a peach of an asset. So, you know, if you are a believer in UK equities, as I am, this I think is a very interesting way to play that renaissance, because you get access to a team with a long-term record, where the discount to net asset values is some 7%, you get a good running yield, and also you get it in a prudently geared manner, because we in conjunction with the board took the opportunity to recast and refinance the debt which we have in this trust at a very low coupon in September 2021, and that gives it strategically long dated low cost debt. So, you know, with that, James, I might just pause and then we can plunge into questions as listeners wish.
Good, no, thank you. I think that low-cost debt is something definitely worth highlighting. One of the things that I'd spent half my career talking about, I suppose in the sort of 90s and early 2000s, was all these trusts that make huge mistakes in taking out long-term, very expensive debt that then cost them a fortune. And I think Edinburgh was one of those. But actually, the stuff that you've got more recently is probably going to be a boon for maybe the next decade to come. We'll have to wait and see. Good. Now, with all of that, if you had to sort of pigeonhole yourself into one of these sort of investment manager labels, is it value? Is it growth at reasonable price? Is it what's the sort of summing up?
Yeah, so the board of Edinburgh, obviously in appointing the team to manage this trust, looked at my and our record in massive detail. They used Willis Towers Watson to do this. And one of the things that really attracted to them was that we have a balance of styles, okay? So within the trust, we have value stocks, we have growth at reasonable price stocks, and we have growth stocks. At any point in time, obviously the balance between those shifts. At the moment, we've got a modest bias towards value stocks, but you know, I choose that adjective modest carefully. And why we do that is because that at the moment is where we think are, you know, the best opportunities at the moment. And I think what we also see is, you know, one of the big things we've seen over this year is obviously a massive change in the long-term discount rate. And, you know, that does have implications for the valuation on a DCF basis of some of the reliable growers and discount rates. So, you know, if you looked at the transaction slide, which, you know, we had, which I cantered through relatively quickly, you'll note that Diageo is one of the largest sales. You'll note that Relex is one of the largest sales. And part of that is undoubtedly the fact that the discount rate has gone up a lot. And therefore, the valuation of some of these reliable growers arguably should change as a result of that. And then obviously led on that, there is also a stock-specific thing. For example, in the case of Diageo, we see a risk of some trading down, frankly, in the US, such as there was in 2008-9. So, you know, James, I'm specifically going to say to you, we don't actually have a particular style bucket that we cling to. We're magpies, if you like, and we're very careful of that balance.
Magpie's not a bad label. I was going to say pragmatic, but yeah, I think magpie's a good one. Good. All right. Within the sort of bias of the, where are we now? Let's find this one here. You are underweight sort of large cap. Has that been a headwind to performance recently?
Well, if you look at performance over the 12 months, which we've shown to October, you can see there we're a nose ahead of the all share index. Then if you sort of now cast through to where we are in November, we are showing continued outperformance. Obviously, what we're seeing at the moment, and the joy of markets, is that every day is different. With the inflation data that we saw in the States yesterday, investors are and have gone very risk on. We've seen the dollar come off dramatically. We've seen changes in expectations in terms of what central banks might need to do in terms of raising rates. And I think what that's done is it's reduced the sort of underlying fear in markets that central banks, to slay the inflation dragon, were going to have to crash, if you like, growth rates. So what we've seen, and you'll see that in markets today, is some of the more leveraged businesses are performing quite strongly. So relatively happy to have an underrepresentation in some of these solid companies, which may not be quite so exciting against that background, the like of Diageo, etc.
Fair enough, that makes sense. Do you actually have for numbers for sort of active share and beta and things?
Yeah, so sort of active share is of the order of 70%, and beta is of the order of 3.5%.
Okay, thank you. There's lots of individual stock questions. We're actually sort of seeing to the sort of high level things. Sort of ESG, which you mentioned, how does something like Shell square with that? And do you think you'd buy something that didn't have a good ESG track record just because you thought it was going up still?
Yeah, so how does Shell fit into that? Well, I think, really what we've learned geopolitically actually is that where you get your energy from is important in terms of the short term. I think, the world needs, obviously, energy, and it's very important to get that energy from companies that want to produce it and have a history of producing it in a way that is as low emitting as possible. And if you look at the journey that Shell has been on, it has, over the last 10, 15 years, been selling down its higher emitting sources of energy. So, for example, it sold its tar sands a good while ago. Last year, it sold its shale assets to Chevron in the States. And it's been gradually moving its portfolio to LNG, which is, as we know, a transition fuel. But I think critically, what it's also doing, obviously, is investing at a reasonable pace in renewables. And the reality is, if we as a world are going to transition in a way that works, and obviously there's a lot of data at the moment that this is a tough ask, and I'm conscious we're talking as COP is going on, and there's all sorts of awful pictures of what's happened in Pakistan, and obviously this day in November in the UK is a very warm day in meteorological records. So this is a very crucial issue. But Shell is one of these companies that is investing strongly behind renewables, and it is aiming to work with its corporate clients to decarbonize their energy needs. And it is one of the few credible players that can do that. And so I think it certainly deserves a role in portfolios. hence why we have it. Your next question, James, is would you invest in a company which had a poor ESG signature if you just thought it was, going up type thing? The simple answer to that is no. But what we are prepared to invest in is companies which we've engaged in that have an improving ESG signature. We don't want, we see one of our roles is to engage and improve. I think we don't want a whole portfolio full of ESG, saints, if you like. Yeah. We want companies that are on the road to Damascus, if that makes sense.
Yeah, definitely, that makes sense. Actually, are you working closely with the ESG team that came out of Alliance Trust?
Michaelis's team is one of the very strong elements in the Lion Trust business. I don't work closely, as in sort of day to day, with his team, and our team don't. The reality is that Lion Trust have an explicit strategy where the teams themselves work independently on their own process. But obviously, one sees what that team has achieved, and it's a very strong achievement.
Okay, thank you. A couple of questions on the dividend. So what sort of dividend cover have you got at the moment, and what sort of dividend growth are you expecting for the UK market?
Yeah, so the dividend, you'll note that the board took the decision to recalibrate the dividend in the teeth of COVID. I think that was a prudent decision. What we've seen subsequent to that is actually dividends come through, pretty strongly. Actually, there's been a mix of underlying recovery, and for a number of our companies, special dividends. So, for example, the Dunelms or Hayes of this world. In terms of cover itself, we're a bit below 1. I think that's a feature that for many investment trusts is a reality. But actually, what we're able to say to investors is that the cover is rebuilding strongly, and we're within a reasonable time frame where we're back to full coverage of the dividend. In terms of dividend growth for the market as a whole, if I'm honest, I tend to look stock specific basis rather than the total, because obviously I'm looking at sectors for whom I can see a step up in dividend paying capability. And a good illustration of that would be the banking sector, where the trust has an overrepresentation, and that is because we see for the first time, and we've obviously seen the beginnings of this, but we see after a decade of something of a drought on the dividend front, now profits are in the main distributable. And so for the likes of NatWest, it is paying, a good mix of underlying and specials. And so that's what I'm really looking to emphasize, James.
Great, thank you. Just while we're on this slide, just one more question. No aim and fledgling small cap stuff in there. Is that just because of liquidity grounds, or?
Yeah, so in the pitch which we made to the board in 2019, we explicitly said that the record which we'd achieved of outperformance since 2006 was based primarily on a strategy which was a mix of FTSE 100, 250 and international, and didn't include the small cap aim. So, going forward, I would not expect us to invest in small cap and AIM. That is just not our ambit for this trust.
Fair enough, thank you. All right, let's dive into some companies. Should be fun. So on this slide, you've got BT on both sides. So what was the story with that one?
Yeah, so the story is a very, I think it's an honest representation of trade. So we bought some BT, then in the second calendar quarter, just a small holding. The reality is that what we can see from BT is on the wholesale Openreach side, that is a strong business. Regulation's very clear. And on the consumer side, we're essentially seeing NPS rise. I think I know why we sold it was just a recognition that actually with rates moving up very, very fast, the telecom sector, and BT is no different, actually is one of the sectors for whom net debt has risen as CapEx has obviously expanded over the last decade. And the reality is, if you now cast BT's debt, the interest charge was going to be a lot higher. So it was one of those hopefully rare instances where we decided to take a loss. I think that was a prudent decision because the most recent set of results which came out led to BT moving further down on the downgrades.
Thank you. There's a specific question about Haleon's debt. Is that something that you're concerned about?
Yeah, so on the face of it, Haleon's debt is very much at the top end of where we'd want companies to be. But this is a very cash generative business, therefore can handle that debt. The debt is termed out relatively far. And as the third quarter reported yesterday, figures showed, this is a business that is showing really strong sales growth, a good mix of price, mix and volume. It's also in some, real peach of a category. So, the category everyone wants to get into is VMS, which is vitamins, minerals and supplements. They've got a great category there. We're also seeing a very strong performance from flu, as particularly in the US, the flu season is I hesitate to use the word strong because strong is obviously means a bit of suffering, but ultimately strong equals decent sales. So, Haleon is a business which I think can handle that debt. It's very cash generative. But yeah, you're right. In the short term, it has reasonable levels of debt. But in a way, debt is good as long as the business is performing strongly.
Great. There's a couple of stocks been kind of paired together in here, and I don't know if they were straight trades or not, but we can maybe discuss them. But Domino's into Greggs and Direct Line into Admiral. What was the thinking with those? Yeah.
So Domino's is obviously a franchise business, and the thinking there really is that where possible, we like companies that control are kind of more vertically integrated, really. Domino's Pizza's effectively had a bit of a standoff with its major franchisees. It also saw the departure of its chief executive. Interestingly, actually, its chief executive has gone to Whitbread. He was a good chief executive, we think, performed very well at Costa, spent a bit of time at Domino's, and is incoming to Whitbread. But if you contrast that with Greggs, so Greggs obviously is a vertically integrated business, as you know. Competitively, it's very strong in that the pricing is standout. It's also got big expansion potential in the way that Domino's doesn't. I mean, it's looking to expand from 2,000 shops to 3,000 shops. It's also got the potential of moving into evening, so that's the 5 to 8 slot, is trialing that. That's going relatively well. And if you think about what it's done moving from lunchtime to breakfast, which has been a massive success, and also the expansion potential is there, because what Greggs has obviously in the past pre-COVID struggled to do is to justify the rents for some of the high footfall places, perhaps in some of the bigger conurbations. Perhaps I'm recording this in London, and Greg struggled to pay some of the rents which were asked. Now, obviously, the rent equation has changed enormously, and they popped up in places like London, King's Cross and Pancras, or a number of these sort of areas, and they're making fantastic returns. So Greggs feels to us a company that's much more in control of its destiny. It's got fantastic financials, a real sort of Michelin-starred model in terms of business, in my view. So that's one. In terms of direct line into Admiral, you're definitely right to pair that. So Direct Line, as you know, is a business spun out of what was the old Royal Bank of Scotland. It's been on a very dramatic tooling up of its IT. Data is crucial in insurance, and the issue is that we haven't seen yet the evidence that IT journey is really coming through in good combined performance. And indeed, the most recent two statements have been a bit disappointing. And why this matters in our view is that it's quite close to its solvency floor, which has implications for its dividend. And within its investment portfolio, it also has quite a chunk of lower quality paper. So you contrast that with Admiral. Admiral is a business that actually has had data at its core for much longer. You can see that in its combined performance over the longer term. And so you pay a bit more for Admiral in terms of the rating, but I think you're going to get much less volatility in its P&L cash flows, and therefore I think it's a better long-term holding. So that's why we decided, after exhaustive analysis, to make that switch.
Great, thank you. Couple more on the purchases side. So you bought Howdens, who's obviously the kitchen people, and Travis Perkins, builders merchants. I suppose the question really is obviously the market mood has changed because of what's going on in the US, but I don't know whether the UK is going to recover as fast. How long do you think it's going to take before the demand comes good? And do you think that those businesses might suffer in the meantime?
Yeah, so let's answer that question through the lens perhaps of Travis Perkins. And obviously you'll be aware that Travis Perkins is obviously the classic green and gold. It's businesses like CCF, it's BSS, which are sort of specialists. It's also Toolstation, but Travis is as in Travis Perkins is one of the big pieces of it. And if you think about what all those areas are doing, it is doing what is repair, maintenance, and improvement. So the I, if you like. Now, it's very difficult to say precisely how these businesses split between that. But, the R and the M are kind of, relatively constant. If your boiler breaks down or whatever, it kind of needs to be fixed. So, it's no surprise if you read the Q3 statement from Travis Perkins that actually they produced a relatively resilient performance. And Travis's customer base is not focused on the sole trader, if you like. So it's very different from like the Wix customer base. Okay. Travis has sorted its pricing. It's much better on the on the interface, the IT side as well. And it's also explicitly moved much more into, the larger customers. And then if you think about one of the big issues, we obviously face, as a country, if you compare our building stock or our housing stock compared to perhaps France or Germany, it's actually much more inefficient in terms of emissions. And, Travis, I think, is a very interesting company, if you like, to participate in the investment that's going to be needed to gradually decarbonize and improve our housing and building stock. And these are huge amounts of money that needs to be spent on that. And a good chunk of it is going to go through the green and gold. So you may be right that some of the I in RMI will be on pause, but I think there will be a strong current of the R and the M. And the reality is the valuation for the likes of Travis is very low, and the balance sheet is relatively strong, and therefore to me it's very attractive.
Good. All right. Thank you. On this side for a second. So where are we in terms of the gearing on the fund at the moment? And what's your sort of view of where the market's going to be over the next sort of coming months?
Yeah, so we're towards the high end of our gearing range, approximately 8%. So we've been building the gearing over the last 2-3 months. You'll be aware that the market has been, a little bit weak over that period, and that's presented, a number of good opportunities in the likes of, Travis, Anglo American, Convatec, Whitbread, M&S, that type of thing. In terms of your second question, where the market will be in 6-9 months, I think the overall market will be sort of modestly higher. I think the more interesting thing is sort of, if you like, what the shape of the market might be, because you'll be aware the market level is a function of all sorts. I think within that, I think that we will see a move towards a slightly more pro-cyclical shape. Hence why, if you look at the shape of the portfolio with a bit more of a mid-cap bias, I think we're well set with that to participate in what I hope will be a bit more of a risk-on type appetite.
Good. Well, good luck with all of that, and definitely well done with what you've done so far. It's good to see Edinburgh perk up a bit after years of suffering. So we'll maybe we can get you back in about a year's time and see how you've been going. But,
yeah, no, I look forward to that, James. So
yeah.
Thank you very much for your time, and thanks to listeners for listening, because we feel, this is a strong project for Lion Trust, and we're very much, working really hard to narrow that discount and endeavour to outperform for our share owners. So thank you for listening.
Thank you. All right. And we'll be back next week, everybody. So next week, Richard's going to be talking to Jeff O'Dwyer from Schroeder European Real Estate, and we'll obviously have the week's news as usual. And then the week after that, we've got another great income fund, Murray International, Bruce Stout, and who's definitely, again, he's had a sort of perk up of performance. So it's going to be interesting to see how that's going and where he thinks it's going from here. So, and then we've got everything booked out to the end of the year. So I think that's going to be our last one now on the 16th of December. We'll be back on the 6th of January. Me and Andrew Mahati, not Andre, I had that wrong last week. I shouldn't have changed it. Talking about the what happened over 2022. So have a good week, and we'll see you then. Okay.